Hello, this is Angie on Bonds, a channel that educates on Treasury Bonds investment for the retail clients. And today we're going to do a comparison between the MMFs and the Treasury Bonds. Which one is better? Which one do you invest in? I know MMFs have been a trend of late and everyone is on MMFs. So what exactly are they and how do they compare to the Treasury Bonds? So Treasury Bonds are loans. They're a loan to the government. To give a loan to the government and they pay you back with some interest every 6 months. Then on maturity of the loan, they give you back your full amount. So MMF, it's short for money market fund. And why it's very popular, it's because it's a very liquid fund. So this is the thing. We have fund managers that can manage your funds. So you invest in these organizations and they decide where your money should be invested, and they give you a contract whereby they'll be paying you a certain amount of interest every month or every 2 months. So they're private organizations that manage your money on your behalf. All you need to know is what interest they're giving you. These private organizations are either owned by the banks or institutions or even individuals. They have different funds. There's a bond fund, there can be an equity fund, MMF, which is the most common one, the money market fund that is, or even a mixed fund. There are various funds under these private institutions which you are calling the fund managers. So why MMF is more popular is just because it's more liquid than the other funds. So some of these fund managers are like Etika, there's Nabo Capital, there's CIC, there's KCB Fund, there's Zimele Fund, there's Mali, there's Corp Trust. There are various, there's several of them and they're owned by different either banks, institutions or individuals. Always ensure that they are monitored by the CMA, the Capital Market Authority. So we'll dwell on this particular money market fund, but always remember that there are other funds managed by the fund managers. So one of the differences is that MMF is liquid. You can easily get your money back anytime that you want, as opposed to Treasury Bonds. Treasury Bonds, once you invest, it's hard to get your money back. To do so, you have to sell back your bond in the secondary market or rediscount at the central bank, which is a tedious process. So yes, MMFs are liquid, bonds are not liquid. To buy a bond, you have to open an account with the CBK, the CSD account, which you can open on the Dow CSD platform. Or you can register a nominee account with any investment bank or a bank, and they can open a nominee account for you where they can buy a bond on your behalf. On the other hand, for MMF, you just register with the organization, just like you open an account with a bank. There are several requirements and you just register an account and start depositing money. With Treasury Bonds, you're buying a specific asset. You're buying a bond. It could be an FXC, an IFP, or a Treasury bill. You're buying something specific. With MMF, you're depositing your money with your fund manager on an agreed return per year. The money in Treasury Bonds is used by the government for its projects. Remember that government is run as a business. But the money in the MMF, once you deposit, will be reinvested in other various assets or investments like the bonds, the bills, the real estate, the forex, and all those. These are people who are managing your money in different investments and giving you a specific return. With the bonds, the minimum amount is 50,000. And with the MMF, some of them are very flexible and can have a minimum amount of even like 500. The likes of Mali and Etika, you can deposit as little as 1,000 and it will continue giving you a return. The duration in a Treasury bond is a minimum of 2 years and a maximum of 30 years. The duration in MMF can be as short as a month or 2 months, depends on what you want, because you can withdraw at any time, depending again on the terms and condition of that particular MMF. In terms of topping up, you cannot top up a bond. You would need to place a fresh bid. So the topping up in a bond is placing a fresh bid for another bond or another bill. But in MMFs, you can always top up the amount and they keep compounding the amount. In treasury bonds, there's no automatic compounding like in MMFs. You see, you can get the coupon that is paid every 6 months and reinvest it in another bond, but you have to initiate that process. You have to place a bid. But in MMFs, you can agree with your fund manager that you want your money, the returns that you're getting, to be plowed back and be compounded. So it can be an automatic process in MMF, but it's not an automatic process in treasury bills or bonds. You have to actually place that bid. The tax element in bonds, IFBs are tax-free, that is the infrastructure bonds. The FXDs attract a withholding tax of 10% or 15% depending on the duration. The longer the bond, the lower the tax. Those are the ones which attract at 10%. In MMFs, there's a withholding tax of 15%, which is not final. The buying or the bidding process in bonds, you have to place your bid on the Dow CST or ask your nominee account manager to place a bid for a specific bond or a bill. In MMFs, you just need to deposit the amount and the amount will keep earning some interest. So what is the risk factor in those two? And I know that is what people keep asking. So we all know that in bonds and bills, they have one of the least risk when it comes to investment, almost at zero. In MMFs, remember they're private organizations, so yes, they are low risk, but there's an aspect of risk because they're private organization. And yes, they are monitored by the CMA, the Capital Markets Authority, but there's just a small aspect of risk higher than the bonds. But however, both of them are low risk investments. So these two are very good investments, and in my opinion, I find MMF very ideal for someone who's starting out on investment and someone who doesn't have much information on specific investments. So you give your money to an expert who decides where to invest on your behalf. But the more you grow in terms of investment and understand an investment, then you're better off investing in a specific asset that you understand that gives you a higher return or is structured in a way that suits your financial goal. Also, I feel like the MMS are very ideal when you want to save up amount, because you could be having a 10k here, a 5k there, and you throw them in an MMF, and with time, after let's say a year or two, then you can be able to throw now that amount that has accumulated in a bond or a bill or a real estate or something else. So it acts as an ideal saving vehicle. So overall, it depends with you. It depends with your financial goals. It depends with your age. It depends with what other investments you have. That will help you decide, do you go for an MMF or do you go for a treasury bond or even a treasury bill? Otherwise, they're both good investments. Remember, if you need a one-on-one financial consultation with me, I can take you through the various investments and help you decide on which investment suits you based on your financial goals. Just get in touch on the email or on the number provided, and let's chat the way forward. And always remember that if your money is not making you some money, then it's losing you some money.